How you doing? You're muted.
Okay, how's that?
I can hear you very well. How we doing?
Not too bad. How about you?
Okay. Doing real well on the tests and everything, huh? So we got to
Yeah, yeah,
keep the
everything's
momentum going here. Um, we're gonna get into, we're skipping over the reason we're skipping over chapters 8 and 9 is we're gonna pick those up later. Those are on the subject of payroll processing, and we want to continue more in a linear march through the financial statements. So
okay.
it's just me and you, maybe give it another minute or so, huh?
Okay.
You doing any work this week or keeping busy?
No, the tax season ended, so I don't know unless they've got some amendments or something for me to do. I've got time on my hands.
That's right. You're the guy who knows Barbara, right?
I beg your pardon?
You're the guy who knows Barbara Owie.
Yeah, uh-huh.
That's pretty good. You ever think of taking her course?
Well, I think I might next time, next term.
Yeah, I mean, you could probably teach that course with her, you know.
I doubt it. No, I tell you, the more I get into this, the more I realize how little I know.
I just had to. I finally put together my last will, you know, and that kind of stuff. And there's so many tax implications, you know.
Oh yeah.
It's complicated by the fact that my family's in New Jersey and Pennsylvania, and the executors in Florida, and all this kind of stuff, you know.
Oh
So,
wow.
all
Yeah.
right. But I have a nephew who was pestering me about when I'm going to do my will.
Uh-huh.
And here's a bad joke to start us off. I said this in my will to my nephew Stephen, who asked me to remember him in the reading of my will. Hello, Stephen. That's an old Henny Youngman joke, but you're way too young for Henny Youngman, I think. All right,
Well,
we might as well get
I know
started.
nothing about any of that. All I know is it's Form 1040 and the related schedules and
There you
forms that
go.
come with that.
I'll just bore you. Obviously, I'm going to have to trim this part of the tape off away from my boss, but I got a letter that scared the heck out of me from the Board of Equal, not the Board of Equal, but the Franchise Tax Board, saying that I omitted the odd numbered pages in my tax return.
Huh.
And I can't believe how, and I think they're right. I can't believe how careless I was. I thought I was double cop. I don't know, but I screwed it up, and all is
Oh,
well.
yeah.
All right, here we go. Let us begin. I guess we're going to go into chapter 10. The subject of this chapter, Roby, is accounts receivable and for sales. Hold on here. I'm just having trouble digging this up. That's the one we want. Let me share the screen and we'll get going here. Share screen. Share screen. You should see it now, right?
Yes.
I'm going to make it a little bit bigger. Okay, we're talking about sales and cash receipts. And Roby, the whole point of this chapter is that when we record a sale, we got to put it into the ledger, of course. And what we're going to see here is we have to keep our regular general ledger going, but we're also going to have what's called a subsidiary ledger, where we're going to have a ledger type page for each customer to keep track of them. And we're going to get into a lot of what are called contra sales accounts. So
Yeah,
sales,
Bob, I watched this this lecture on video. Aren't we supposed to do chapter 11 today?
oh, is today chapter 11?
Yeah, that's what your syllabus says here.
Hey, I'm easy. I already talked about this, yeah?
Well, yeah, I watched. I think it was last week, and I watched it on video on YouTube.
Sounds good. Hold on, pal. We'll get the right one going here. Chapter 11. Let's see what we got in chapter 11. Here we go. Let me share the screen. You see it now?
Yes. Mhm.
Okay. Okay, as I was saying, we're supposed to do chapter 11 today. Chapter 11. If you understand chapter 10 in terms of sales discounts and sales returns and allowances, and how we never debit sales, as you should know by now, this is sort of the reciprocal. Now we're on the purchasing side where we're never going to credit purchases. We're under an accounting system right now until we get to chapter 13, where we are debiting a cost account called purchases when we buy merchandise. So we're not debiting an inventory or asset account. We're debiting a cost account called purchases, which we will adjust at month end with a physical inventory. So whereas in chapter 10, we talked about sales discounts and sales returns and allowances, here we're talking purchase discounts, purchase returns and allowances. They are contra cost accounts with a debit balance. So it's got the contra sign control going. So let me move this out a little more here. This thing keeps getting in my way. Merchandise purchase transactions. Purchases returns to merchandise acquired for resale. I think we know that. This, I'll skip this slide. Procedures vary depending on the business. Of course, we could have cash or the next few pages of this slide, Roby's a lot of reporting on paperwork that I think is somewhat old-fashioned. Um, Typically, in a fairly big company, you are an accountant in the office, and you decide you need a new computer. Your laptop on your desk is not, your desktop is not working. You don't have the authority to buy that, but you do have the authority to request it. So you pick up a form called the purchase requisition, you fill it out, what you want, and then you give it to the appropriate approving party, perhaps your boss, and it gets over into purchasing. And then purchasing's job is not just to buy it, but to buy it the best quality at the best price, using their expertise, using their massive size to, throw their weight around. When the item comes in, you will fill out a receiving report, your shipping and receiving department probably, and you'll get it, and then you'll get the invoice from the customer. So they're just going through a little chain here. And this slide is worth looking at because I know on the can test that you get, they ask about these things. Purchase requisition, it's just that, it's just a request to your boss. And they're complicating it with this 3-copy thing. Yeah, that can be true. It can just as easily be an email to your boss or a text. Boss, my computer is no good. Wait, can you help me out here? That could be your purchase requisition. And you can tell this is kind of an old-fashioned looking, huh? When you see this blue type and quality bikes, this guy wants to buy 3 levers, one of these, 2 or 3 of these, 2 of these, okay? Notice there are no prices on a price requisition. The price requisition doesn't have prices on it because all you're doing is telling somebody who is in authority to approve this. Once it gets to purchasing, then they'll worry about the prices. Purchasing might contact you and say, what do you think? Is this a good deal? But at this point, we're not worried about the prices. The purchase order is written once the purchase requisition is approved. And it's a written order, as you can tell, to buy goods. And the purchase requisition is a contract between you and the seller. You've just called this guy and said, I want to buy this particular computer and I want it programmed this way. You sign that order. You pretty much can't get out of it. Okay. And typically in the old days, 1 copy, yes, you send 1 copy to the seller, you send 1 to accounting, 1 to purchasing, whatever. The purchasing department would be the people to fill this thing out. And now we are looking at the prices. Our purchasing department at Sunflower Cycle went around and they decided they agree they'll buy it from Quality Bike, which was what was in the requisition, but that could have been changed. And here they're pricing it out. It looks like we're going to spend $760.60. The machine parts come in. into your factory, into your store, and someone's got to write up a receiving report. And this is pretty normal. A receiving report, you write down what was received or check off what was received. And usually the receiving people will have a copy of the purchase order down there, and they'll just staple the receiving to it. So it'll come up to accounting for processing. And they're saying it could be a separate form or it could be the vendor form. Receiving report, what did we get? And then, of course, usually when you get the receiving report like that, you'll get the invoice right away from the seller who wants to get paid. In chapter 10, it was a sales invoice. We're on the other side now. Purchase invoice. And the accounting department sits there and I think companies still do this. You're looking at a physical invoice. So you're making sure it's the right rec number, the right purchase order, that what you received is correct. In the old days, my boss even made us multiply it out to make sure there were no mistakes in the extensions. So it's an internal control. Double check your invoice. And here it is right here. And here you can, I'm sorry. Now this is from the bike company. This is the bike company's sales order. See what it says our order number? This says your order. That's our purchase order number. And this little stamp here, this is what I used to see. The accounting person, the accounts payable clerk or accounting guy would stamp this thing, and it's got the date received by, all these different things you're checking. So that's just a brief journey through the possible forms, okay? It's a process. Depending on the size of the business, maybe a lot of the employees have authority to buy things. When I was the CFO of the Santa Barbara neighborhood clinics, we had a pain in the neck with the purchasing. You know, one clinic would need some gauze, another clinic would need some of this. And I set up a deal with a company where the clinic managers and the program managers, we're talking about 10 people, Roby, they could buy whatever they wanted without any purchase requisitions at all. They could buy anything they wanted anytime. The check came at the end of the month when the bill came from the company, because I had them all buying from the same vendor, and I would just check what they spent against their budget. And that was the control there. And that type of thing can work. It meant we didn't need receiving reports. We didn't need a lot of these things as long as they stayed within budget. So here we go. Cash discounts. You remember this, right? 210 net 30, right?
Right.
210 net 30. One man sales discount is a chapter 11 purchase discount. Okay. Not to be confused with a trade discount. A trade discount is typically this. You're a big manufacturer or let's say wholesaler. I think we're talking about mostly a wholesaler. And you have a catalog of all your products and you send it out to Nordstrom's and everybody, and it'll have a list price on there. And then you'll see right on the material that we're going to give you a discount of 30% if you order. This type of discount does not belong in the accounting records at all. This is just what they call a trade discount, usually offered to good customers. Here's our deal. We sell this stuff for $400. Roby, you can buy it at your company for $300. That's called a trade discount. It does not get recorded into your financial statements. The 300 is where you're going to start. The buyer and seller both record the transaction after the trade discount, okay? So on the test, you might see true or false, a trade discount is the same as a cash discount, and it is not recorded. Cash discount, we're talking about the 210 net 30, okay, after deducting the trade discount. Okay, purchase invoice. Describe and use merchandise purchase accounts, and I think that says cost of goods sold or cost of sale. Oh, compute gross profit. Okay. I couldn't read that right-hand corner, getting ahead of me. Okay, here we go. Instead of sales, we have purchases. Instead of sales returns, we now have purchase returns and allowances, and we now have purchase discounts. And we're throwing something else into the mix called freight in. Freight in is the cost of trucking the goods into your building, the cost of the UPS guy perhaps bringing it in. It's considered really part of the cost of the asset we purchased. It's an asset until the end. It's an asset only at the end of the month when we count it. Under this system, we start off as a purchase, which is a cost. Freight in. In this chapter, you don't have to worry about credit card fees. That doesn't cut any ice in this chapter. And there's no sales tax payable to worry about. Because when you buy something from you're a company and you buy something and they charge you sales tax, you don't set up a separate sales tax account. It's all considered part of the purchase. So here we go. They are showing us a new part of our chart of accounts. And what we have here, that's nice and big. Hey, just to digress, Roby, I was able to get into my office the other day. Cornelia and I had an emergency to go there, and I managed to copy the better files down. So now I can do the zooming and stuff a little better. But here we go. Notice they've got the purchases under expenses. Purchases are part of what you're going to learn later. It's called cost of goods sold, okay? So purchases have a debit balance. We buy $1,000 worth of merchandise for our store. We're going to debit purchases and we're going to credit accounts payable or cash. If we return something, since we never credit purchases, just like we never debit sales, we are going to record that return with a credit to purchase returns and allowances, which has the impact of reducing our cost. And the offset is not going to be accounts receivable, but accounts payable. And then you have the same thing here with the purchase discount. Purchase discount. This reduces our gross purchases, if you want to call it gross purchases, by crediting the contra account purchase discounts. These are contra cost accounts, contra purchase accounts. Sales discounts were bad, right? They reduced our sales. Purchase discounts, hey, that's good because we reduced our cost. And if there's any freight involved from a common carrier, that is freight in expense. And that's going to line up with these guys on your income statement. We bought $10,000 worth of merchandise. And when it was delivered, we got a bill also from the freight company for $500. That would be debited to freight in and would be considered another purchase expense, just in a different area. Okay. So you can see this chapter is not a buzzsaw, right? So far, Roby. Makes some sense?
Yeah, okay. Pretty clear.
Here we go. Purchases. What is it? It's a cost. It's debited when the merchandise is purchased, and it's credited only during the closing process. In other words, you never credit it. You never credit it except to close it, okay? Under this system we've been teaching since the course began, we are in what's called a periodic system. When we get to chapters 13, 14, 15, I think you'll see a little more interesting when we get into a more normal perpetual system. But under this system, we have to put everything into our income statement as a cost, because under this system, we don't record the cost of goods sold at the time of purchase. We only record the sale. We have to take a physical inventory at month end to straighten things out, okay? So purchases is a debit account. It's a cost. And wow, look at this. We bought something for cash. We debit purchases and we credit accounts payable. And you can put the vendor's name if you wish. And again, that nice short bullet, made purchase on account. You could even get rid of the word made, purchase on account, huh? So that's our reciprocal to a debit to accounts receivable and a credit to, here I am stumbling. It's the opposite of the sales transaction, okay? If we sold, it'd be a debit to accounts receivable and a credit to sales, okay? Purchase returns and allowances. Here we go. A contra account used to record items we return. Has a credit balance since purchases are a cost account. And you credit this for the returns and allowances, and you never debit it. Never. The closing process, I don't count. We know we have to zero it out. Okay? So you never credit purchases, and you never debit these purchase returns or purchase discounts. So here we go. We returned something. We returned $200 worth of defective goods. We got approval to bring it back. Here is our journal entry. We debit accounts payable because we no longer owe the $200, right? We credit purchase returns and allowances because we never credit purchases. That's the accounting rule. And we want to isolate purchase returns and allowances. We want to keep track of these. We want to know how much of the stuff we're buying are we sending back. Are we buying something from a vendor and we have to send half the stuff back to them? That's the type of thing we want to know, okay? Purchase returns and allowances. Example 2 here, the same merchandise is returned, but the seller gave us a price reduction. In other words, we sent back this $200 microwave and we said, this thing is not what I thought. It doesn't do quite what I want. I'm going to return it. And the vendor says, I tell you what, pal, I tell you what, Roby, you keep it and I'll knock $45 off the price. That's all we're doing here. The subtle difference between a return and an allowance, that's all. Allowance, I guess you could say, is a little more negotiable. Purchase discount. Sales discounts are debits and they reduce sales. Purchase discounts are credits and they decrease costs. And you are never going to debit this account. Purchase discount, here we go. This is an exact mirror of Chapter 10. In Chapter 10, this transaction would have been a debit to cash for $98, right? It would have been a debit to sales discount and a credit to accounts receivable. Now the other, this ox is being gored. Now we're the buyer. So we took advantage of the discount with $98 in cash. We reduced our costs by 2 and no longer owe $100. Okay, so far, Roby?
Okay.
Trade-in. I love that word, an adjunct purchases account, but that's what it is. It's really part of purchases. It's just that you want to isolate it. This is the transportation cost of bringing the goods into the factory. Sometimes the transportation is a lot more than the product itself. You might be buying some cheap parts that are very important to your business, and you paid $100, but the truck driver charged you $500. Anyway, freight in is part of the purchasing. Here we go. Now here's something I think is a little more interesting and make us think a little bit. Free on board, FOB. Have you ever heard this expression, FOB? No?
Yeah.
Okay. You have any idea generally what we're talking about here?
Yeah, if it's free on board, that means the shipper, or rather the customer, pays the freight. And
if it's free, there's 2. Free on board. Did you say free FOB shipping point?
Free on board destination. Yeah, that means that the customer pays the freight. And if it's free on board supplier, the customer pays the freight. And if it's free on board destination, the shipper, the manufacturer pays the freight. Is that right?
I think you said it right. I kind of lost you there, but I think you did say it right. FOB shipping point. FOB, the way I like to teach this, Roby, FOB, that's the point when title changes hands from the seller to the buyer. So if it's FOB shipping point, the buyer pays for the transportation. The buyer owns that item as soon as it is shipped. The buyer is responsible for insuring it. The buyer is responsible for hiring the truck driver or picking it up. So FOB shipping point, you're absolutely right. FOB shipping point, since the title changed to the buyer pays for the freight. Okay. And freight charges can come on the invoice itself as a separate line item, or you might get a bill from a common carrier. You might get a bill from Yellow Freight Company or something. So FOB shipping point, once that truck leaves our campus, we just loaded up a whole bunch of things, a whole bunch of glassware from my little shop in downtown Newark, New Jersey. And as that truck left our campus, it got in an accident in front of the 7-Eleven down the street here. FOB shipping point means that I'm responsible. I own that. If that truck got into a crash after you got it, that's different. FOB destination, now the buyer is responsible for it. The buyer, I'm sorry, I'm saying it backward. The seller's responsible for everything because the buyer doesn't own it until it arrives at his factory or store. And I'm just going to digress just a bit. Companies sometimes actually argue about this. This can be kind of strategic. I worked for a company a long time ago that had no money. It was tough to pay the bills. We had a borrowing arrangement with Citibank. Whatever our inventory balance was at the end of the month, I could immediately borrow 80% of that. So I used to have to call up the freight guy, not the freight guy, but the shipper in Bartlesville, Oklahoma, and say, hey, Randy, could you put a rail car filled with resin on the track right now and get it going? And let's make it FOB shipping point, because then I could add that to my inventory and borrow. So maybe I'm complicating this a little too much, but FOB shipping point, the buyer's responsible. FOB destination, the seller is. And here's an example of freight. You bought something for $400, and then I guess on the invoice, they had a separate line for the freight. So we're just going to keep that separate. So the purchases is only for the cost of material. Remember, we said that the sales was always a multiple of the units times the price. That's what we're talking about here. So purchases 400, freight in 438. We owe this vendor $438. If the freight company charged us, if the freight charges were on a separate bill, we got this from Yellow Freight. We're going to debit purchases. I'm so sorry. We're going to debit purchases for 400 and credit accounts payable. That's the bill we got. That's all that was on the bill from the seller. Here we got a separate freight bill. That's all. Debit freight, credit accounts payable. Has the same impact. We still owe $438. We just owe it to two different people. Make sense?
Yep.
That's the freight company on the bottom. Gross profit. Have to know this like the back of your hand, huh? Gross sales minus cost of goods sold equals gross profit. I will say that again. Sales, net sales minus cost of goods sold equals gross profit. It's just the difference between the two. It just means that we sold something for $100 net sales and we paid $30 for it. So that's the cost of goods sold. Okay. So cost of goods sold is just that, what we paid for the goods. It's the difference between the goods available. They're getting a little bit ahead of us here. Cost of goods sold, difference between the goods available. I'm skipping that because that's a little bit irrelevant here. Computation of gross profit. Now, here's where things are going to get a little more complicated. But again, you know me, it's always interesting, you know. What they're showing you here are the elements of cost of goods sold. Cost of goods sold. We, under a perpetual system, which is not what we're learning here, the cost of goods sold, Roby, is recorded at the point of sale. You sold something for $201,500. So you debited accounts receivable and you credited sales, okay? Then at the same time, you recorded the cost of goods sold. You paid $100,000 for this, you know that. So you're going to still have that same entry here, sales 201, but you're going to debit cost of goods sold for 100,000 and credit inventory. Under this method here, since everything has to go into a purchases account, we have to calculate the cost of goods sold at month end. And we're going to show that calculation. And this is going to be a good part of the chapter, I hope, huh? So what are they telling us? We got sales returns, we got purchases and 2 returns, freight in, and they're telling us for a reason. We have a beginning inventory, which was the inventory at the end of last month, and now we have this month's ending inventory 31 days later. These elements are all needed to come up with the cost of goods sold or net profit. Net sales. Let's not have any problem with this. Students do seem to get a little confused with it. Net sales. They are gross sales. I wish they would use the word gross sales here, and I wish they'd laid this out more clearly. Gross sales minus sales returns and allowances, minus sales discounts, minus credit cards, which they don't fees, equals net sales, okay? Gross sales minus these returns and discounts, that is your net sales. The computation for cost of goods sold is as follows. Beginning inventory, I wouldn't write this down yet because it's too condensed. Beginning inventory plus, I'm skipping this. Cost of goods available. All right, let's work with it, Roby, you and me, huh? Cost of goods available. You have a beginning inventory of 1,000 books in your bookstore. Then you purchased more books. You purchased another 10,000 on top of that 1,000. That's how much you had available for sale. Simple concept, but very important when we get into the calculation here. Beginning dollars were $1 million. You purchased 2 million more. That's 3 million. That's the most you could have sold. Makes sense, right, Roby? You can only sell what you had at the beginning and what you bought. At the end of the month, you have to count what's left. And the difference between that available number and what you counted, voila, is your cost of goods sold. So let's look at this a little more. Cost of goods sold. I just don't like the way they're presenting it, but we can work through this. Cost of goods sold equals that available number, right? The available number is the beginning inventory plus what we purchased. That's the most we could have sold. We either sold it or we didn't. Month end comes and we find out of the 129.5 available, 18 was not sold. There is your cost of goods sold number. It pops out just like that. So our gross profit is going to be the net sales minus the cost of goods sold here. Our net sales, they gave us a number up here, 201,500, minus the available number, which was 129.8, gives us the inventory number or vice versa. You okay with that, Roby? Am I confusing things a little? Okay. Gross profit. So gross profit is net sales minus cost of goods sold. And if there's a God in heaven, they'll show it on a grid like this. Now we can really look at it. Now this really confuses students. They see that this is kind of a larger presentation. They tend to get a little bit intimidated. But let's not. Let's divide and conquer. If we know that our net sales are gross sales minus returns and allowances, minus sales discounts, minus credit card fees, we have 1/3 of the problem licked because we know net sales minus cost of goods sold equals gross profit. Gross profit. So what are they showing us here? We had a beginning inventory of $26,000, right? We purchased 105,000. Of that 105, it looks like we returned 800 of it, and we enjoyed a purchase discount of $1,000. So just like we had net sales up here, we've got net purchases. It's the exact reciprocal, right? But we also had to pay some freight. So we add the 300 to those purchases, and we can call those net purchases, if you will. They're calling it cost of goods purchased, but it's the total purchase. So the 26,000 in the beginning, plus the amount we purchase, is what's available, is what is available. Okay? This is the most we could have sold. If we sold everything, this would be the cost of goods sold. But we didn't sell everything. We still had $18,000 worth of shirts and coats in our store. So we leave this in the inventory. We subtract out. There is our cost of goods sold. Net sales minus that equals gross profit. Any questions on this, Roby?
No, pretty clear.
Yeah, it's not too bad if you divide and conquer. You know, net sales, and if you have that idea of what's available in your mind, and what's available can only be sold, we're still on hand at the end of the month, makes it easy. But I know the class is going to struggle with this. It's just been my experience. Okay, so we went through the accounting side, putting things into the general ledger, how to come up with the numbers. What they're going to show us now is, do you remember in chapter 10, we had what was called an accounts receivable ledger, one for each of our customers? Guess what? You're going to have one for each of your vendors too. The total of this ledger has to equal the total accounts payable in your ledger. Accounts payable ledger. You're going to have one general ledger page, or ledger page, if you want to call it that, for each of your vendors, each of your suppliers, and they'll probably have a number in your system. And the summary accounts payable account maintained, that's called the controlling account. Anything in the general ledger is known as a controlling account. Any other ledger that details it is called a subsidiary. So what do we have? We have accounts payable, $1 million. And our accounts payable ledger will have, this person owes us 100,000, this guy owes us 3, until that adds up to that 100,000. Purchases example. Okay, they're bouncing around on us. Assume the following purchases. Let's just take a peek at it real quick. Purchased, I want to clear my screen here. You don't see what I'm missing. Here we go. Purchase merchandise from CycleWorks, $3,300, and the terms in net 30. So they're deliberately not confusing us yet with purchase discounts, okay? So we purchase. We are going to debit purchases and credit accounts payable. You notice in chapters 10 and 11, there's no cash sales or purchases, right? So let's see what they're telling us here, and I'll blow this up. Ooh. I would like to zoom. Okay. Well, this is pretty easy. This is just a quick layup drill, if you will. You know, just a little batting practice. We debit purchases and we credit accounts payable. Excuse me, I needed that snort here. Okay. And over here, under accounts payable, maybe you list the vendor. And you could have a little explanation, but the invoice number suffice. Oh, I'm sorry. I do want to go back to this. Zoom. Oh, Zoom, will you? Zoom. So it looks like these entries are all the same. Would you agree?
Yeah.
Pretty much. Here, they're going to show you how to put them into the general ledger. We should already know how to do this, huh? We know what the general ledger is. We're going to put in the date and the amount and a new balance, and we might have a reference number. And then we have to put it into the ledger account number in the reference column, the post reference. So here we go. Pretty basic, huh? Here's our journal entry. Debit purchases, credit accounts payable. Purchases, they're taking us on a long journey here. Purchases, $3,300. Credit accounts payable, $2,500, those two. Credit accounts payable, debit purchases, we get a new balance, huh? Any problem with that, Roby?
No.
I would I would hope not here. Now, the accounts payable ledger. Accounts payable ledger, it's the same exact thing, except we're not going to have just one accounts payable page or ledger. We're going to have one for each vendor. We're going to have one for Belenky, one for Ellsworth, etc. So on the accounts payable ledger, it's the same thing. You enter all this information here. So here we go. They're showing the same two vendors, and they're repeating this part here where you debit purchases, credit accounts payable. But here we go. The first one was a sale to Belenky. So you have a separate ledger page just for Belenky. He owes us now $3,300. We have a separate page for Ellsworth. He owes us $2,500, and the balance would continue. And we do understand that the total of all of these balances must equal this general ledger balance of $10,600, right? In this case, they're just showing you two of the five, that's all. Let's look at a purchase return. We just returned something. Sunflower Cycle returns $200. So we know we never credit purchases, but we do credit purchase returns and allowances. So let's take a look here. There it is. Here's our journal entry. Debit accounts payable, credit purchase returns and allowances. And this is easier in a way than the sales chapter because there's no sales tax payable to worry about. Okay, no sales tax payable. That's an issue only for the seller. So here's our accounts payable. That was reduced by 200. Since you know we never credit purchases, we credit the contra. Okay, so that looks pretty clean. And then we come over to Belenky, and we had originally sold Ram's Design. Oh, they're using a different vendor. I'm sorry. We originally sold $5,300 to Rand's Design. We only own $5,100 now since he approved the return of $200 worth of merchandise. Paying cash payments. Let's see what they're saying. SunCycle made these payments. We paid Ace Wheel $48 on account, and we paid Gunnar Cycles $8,700 less the purchase discount. Oh my goodness, that's way too big. What happened? Let me try one more time. Hold on. Can you read this okay, Roby? Do I need to blow it up?
No, it's fine.
Okay. It's easy for you to say. Ah! I just have to move something again. Okay, here we go. All right, we bought something for $4,800. Now we're paying for it. Debit accounts payable, which has a credit balance. So we zero it out with a debit, and we credit that asset account cash. Here, we got an $87 discount. So we made a payment of $8,700 minus this discount, which is a cost reduction. That's a contra purchase account, a contra cost account. We relieved an entire $8,700 debt. The difference is cash $8,613. You okay with that, Roby?
Yep, got it.
Yeah, you should be good. If you could do tax returns, you should be able to do this. right? Anyway, here we go. And they're just taking us through the same process as they did with the sales. Wow, that's nice. Oh, I love that. Ah, I spoiled it. Oh, I hate myself. There we go. So you can see we made the payment of $4,800. We credit cash and we debit accounts payable down here, accounts payable. And over here, they're showing the discount. There's our discount account. That's where you see the credit. The entire debt is relieved, the entire 8,700, both from the accounts payable ledger and from the general ledger. So I think you're good with these, right?
Mm-hmm.
And then the last thing, I assumed the last thing in the chapter was a schedule of accounts payable. Well, this is easier than falling off a chair. It's just a list of all of your vendors and how much they owe you, probably in alphabetical order. And that balance better equal your general ledger balance for accounts payable. And this is our verification prepared at month end. You can prepare this anytime. And the total of the schedules must equal the accounts payable balance. There's nothing more annoying or embarrassing at the end of the month to print out an accounts payable schedule and it says you owe $1 million, and then you look in your general ledger and somehow, some way, the balance is $1.2 million. I don't know if that can really happen anymore with computerized systems, but that's the kind of disaster I used to run into once in a while. There it is. Our balance in accounts payable on the general ledger is $11,900. It is owed to these four people: Belinsky, Ellsworth, Milwaukee, and the Rams. Pretty simple again, huh, Roby?
Yeah.
The only thing tricky in this chapter is computing the cost of goods sold. And I like I said, I don't get to see the test really before it's administered. But when I would give the test out, I have a lot of multiple choice problems that made you pick up a pencil a little bit. I would say something like the goods available for sale are 100. The ending inventory was 40. What was the cost? What was the cost of goods sold? That type of thing. So I would expect you to see things like that. And I'm not going to go over finding accounts payable errors. My advice is don't make errors. Any errors that are made are not going to be the result of your system. So as long as the items balance correctly, it's going to accept your information. What I'm getting at, if it's a manual system, it's easy to make a transposition error where you meant to put in the number 72 and you put in the number 27. Those are the types of things that you might look for. And the net price method of recording purchases, don't worry about that. And that's pretty much this entire chapter. Not too tough, huh?
No, got one question though.
Yeah.
You said you never debit sales and you never credit purchases, but don't you? And did you say at the beginning of our class that you don't close these accounts off to the income?
You do close them.
Oh, you do close them to the income summary.
That
Okay.
Yeah. When I say you don't debit them, I'm not talking about the closing process.
Okay, so that's the only time you debit or credit these accounts. Huh?
Only to close them.
Okay, got it.
Yeah. I don't know if that's a good way to present it. Maybe that makes it a little more confusing, but that's the point. You close them, but that's it.
All right.
Yeah, that's a good question. By the way, my Jets lost 24-0 yesterday. They still, it's so funny reading the New York tabloids. They just want to kill this poor coach. I feel so bad for the guy. But all right, what else you got, Roby? Anything?
No, that should do it for now. I'll see you next week.
All right, I guess you can hit the bricks then, huh, pal?
Yep.
All right, we'll talk to you next week.
Okay, thanks.
Hey,
Bye-bye.
bye-bye.